tough on countries if they don't go along with Greenland, because we need Greenland for national security.
It's a rough start to the week for global markets, and the trigger is coming once again from Washington. US President Donald Trump has issued his strongest trade warning yet, this time targeting 8 major European economies. This is not a routine threat, it matters, because Europe is not just another trading partner, it's the world's largest trading bloc. If this standoff escalates, the consequences will not stay confined to Europe or the United States, they will be felt across the global economy. Markets have already begun to react. Let's start with Asia. In India, equity markets often sharply lower. The Sensex lost over 300 points, while the Nifty slipped by nearly 1%. The pressure extended to the currency market as well. The Indian rupee weakened for the fourth straight session, trading close to 91 against the US dollar. These moves may appear modest at first glance, but together they signal a deeper problem: investor anxiety. When uncertainty rises, investors pull money out of risky assets, and that is exactly what we are seeing. The story is similar across Asia. Hong Kong's Hang Seng index fell by more than 1%. Japan's Nikkei declined by over half a percent. These markets are taking cues from Europe, where losses were already visible early in the trading day. The STOXX 600, which tracks major European companies, slipped by around 1%. Germany's DAX DAX dropped more than 1.2%. France's CAC 40 fell by 1.4%, and Britain's FTSE 100 also traded lower. The US markets, meanwhile, are closed today due to Martin Luther King Jr. Day holiday, but analysts expect fragile when trading resumes, as investors digest the implication of a possible transatlantic trade clash. So what does all this tell us? It tells us that risk appetite is fading. Investors are moving away from stocks and rushing towards safe haven assets. Gold is the biggest beneficiary. Prices of the precious metal surge again, hitting a fresh record. 1 ounce of gold is now trading close to $4,700 in international markets. Such a sharp rise reflects fear, not optimism. Investors are bracing for uncertainty and preparing for prolonged instability. And there's a vigorous locking beneath today's market's moves. This time, the United States is not confronting a small economy or a traditional rival. It's clashing with its largest investor and lender. Europe holds a powerful cut, around $8 trillion invested in the United States. This includes holdings in American stocks, government bonds, and other dollar-dominated assets. Now imagine this scenario. What if Europe starts pulling back the money? What if European investors begin selling US assets on a large scale? The impact will be immediate. The US dollar could weaken, borrowing costs in America could rise sharply, financial markets will become volatile, and inflationary pressures could intensify. Economists even have a name for this possibility. They call it the Sell America option. We have already seen a glimpse of it. Last year, pension funds in Denmark quietly reduced their exposure to US assets and brought capital back home. The move was limited, so markets barely noticed, but today's situation is far more serious. For decades, European investors viewed the United States as a safe and predictable destination for capital. That confidence was built on strong political ties and economic stability. Trump's tariff threats are now shaking that trust, and that is why what seems once unthinkable using Europe's investments as fragile is now being openly discussed. The question is this: will Europe actually pull the trigger? Actually, it won't be an easy decision, and if Brussels does act, the fallout will go far beyond Washington and Europe's expectations. It will send shockwaves through global markets, affecting economies worldwide. This is no longer just a trade dispute, it's a test of confidence in the global economic order.